Usually when we talk about a medical diagnosis, there's this expectation of absolute precision.
Right, like it's engineering or something?
Yeah, exactly. It's like you fall off a bike, you break your arm, and the x-ray shows that jagged white line right across the bone.
The problem is right there in black and white. It's totally binary. The bone is broken or it's not.
And there's something deeply comforting about that, even if it hurts. We really like our problems to be visible, to be neatly categorized, and to have a definitive origin point.
But then you step into the world of complex corporate finance.
Oh boy, yeah.
Specifically, commercial real estate portfolios operating on this massive global scale, and suddenly that x-ray machine is just broken.
Or worse, the x-ray is showing you shadows that aren't actually there.
Right.
While completely obscuring the fractures that are.
Exactly. And we're looking at a diagnostic landscape right now that is just incredibly murky.
Well, welcome to this Talk Tickers Deep Dive. Today, we are looking at a company that is quite literally the physical scaffolding of the modern internet.
American Tower.
American Tower,
Yep.
ticker symbol AMT. And to figure out what is really going on beneath the surface here, we've pulled together a massive stack of sources.
We really have.
We've got their Q1 2026 earnings call transcript, a whole pile of recent Wall Street analyst notes from Morgan Stanley and Goldman Sachs. And we're even looking at some really fascinating IE industry research on edge computing power grid demands.
And it is a critical time to be examining American Tower. They are sitting right at the intersection of the world's most capital-intensive technological trends right now.
For sure. They're the backbone for 5G deployment, right?
Yeah, and the necessary infrastructure for the upcoming transition to 6G. Plus, they're actively trying to position themselves at the center of this massive AI infrastructure boom.
And this is but if you look at their headline numbers for this first quarter, the X-ray is incredibly messy.
Yeah, the narrative is totally bogged down by past corporate mergers in South America, these massive one-time lease cancellations here in the US, and just some serious accounting noise.
Noise that makes their top-line growth look completely contradictory to their actual operational momentum.
Exactly.
So our mission today is to translate that Wall Street jargon and that noise into the fundamental numbers you can actually use. We need to figure out if the headwinds they're facing are structural, meaning, the foundation of the business model is actually cracking, or if they are just event-driven potholes.
And that distinction is everything when you're looking at a REIT.
Yeah.
The market is pricing American Tower right now as if the growth engine has just completely stalled out.
But when you dig into the mechanics of what they actually own and the physics of how mobile networks have to evolve over the next decade, a very different picture emerges.
Let's jump right into those headline numbers.
Okay, yeah. So the core metrics. Consolidated property revenue grew roughly 3% year over year.
Right.
And for a company positioned at the center of the AI and 5G revolution, 3% growth is, it's not exactly going to get your heart racing.
No, not at all. If you're an investor just looking at a basic stock screener, that number looks totally stagnant.
It does. But this is exactly where the diagnostic X-ray is misleading, isn't it?
It is, because that 3% number is their reported revenue. But the analysts on Wall Street are heavily discounting that figure because it includes a massive localized distortion.
The Dish A network churn.
Exactly. If you strip out the one-time hit from Dish H canceling their leases, revenue actually grew 5% on a cash FX neutral basis.
Okay, let's unpack this, because I have to push back immediately. Management teams love to play this normalized game.
Oh, they do. All the time.
They essentially get on the earnings call and say, hey, if you ignore our biggest disaster of the year, our numbers are actually fantastic.
Right. Other than that, Mrs. Lincoln, how is the play?
Exactly. And as an investor, you can't just ignore a massive customer packing up their equipment and breaking leases. THH was supposed to be the fourth major nationwide carrier. They signed these ironclad master lease agreements. Now they're churning out of the portfolio. Isn't normalizing these numbers just putting lipstick on a pig?
I completely understand the skepticism. And honestly, whenever a management team points you toward an adjusted or normalized metric, your radar should automatically go up.
It has to.
But you have to look at the mechanics of why Dish is churning. This is where the distinction between a structural decline and an event-driven headwind is crucial.
Okay, so break that down for me.
So the Dish churn represents a massive 400 basis point headwind to American Tower right now. That is real money they aren't collecting. But we need to understand the history of how Dish got onto those towers in the first place.
Right. This goes back to the T-Mobile and Sprint merger, doesn't it?
It does. When T-Mobile bought Sprint a few years ago, the Department of Justice required them to spin off assets. They wanted to create a fourth nationwide carrier to preserve market competition.
And Dish Network bought those assets.
Yes. And they were legally obligated by the FCC to build out a cloud-native 5G network from scratch. They had to cover a certain percentage of the U.S. population by a very specific deadline.
Oh, right. To hit that deadline, Dish City went on a massive leasing spree.
Exactly. They needed vertical real estate immediately, so they signed long-term agreements with tower companies like American Tower.
But Dish, as a corporate entity, has run into some really severe financial and strategic difficulties lately.
Severe is an understatement. Building a nationwide network from scratch costs tens of billions of dollars, and Dish's core satellite TV business has been bleeding cash for years.
They just ran out of runway.
They did. So they are canceling leases and scaling back their ambitions incredibly aggressively. And here is the critical point for investors. Dish isn't leaving American Tower because terrestrial wireless is obsolete.
Right.
Or because a competitor offered them a better, cheaper tower. They're leaving because their specific, highly leveraged business model basically failed.
Okay, so the utility of the tower itself hasn't diminished at all. The location is still valuable. It's just that one specific tenant went bankrupt, essentially.
Precisely. And once American Tower scrubs those dead DSA leases off the books over the next several quarters, that revenue drag stops compounding. It just washes out of the year-over-year comparisons entirely.
And meanwhile, what about the other tenants?
That's the key. The remaining tenants, AT&T, Verizon, and T-Mobile, they are actively expanding their 5G networks and adding equipment to those exact same towers. That underlying highly capitalized tenant base is growing at 5%.
Wow, okay.
And that 5% is the structural reality of the business going forward, whereas the Dish churn is just a localized decaying event.
Okay, that makes the 3% reported top line make a lot more sense. It's hiding that 5% core growth.
Yeah.
But the turbulence shows up on the bottom line too.
It does.
Looking at AFO, that's adjusted funds from operations, which, and for a REIT, is basically the equivalent of earnings per share. On paper, it declined by 1%.
Right, another scary headline number.
But applying that same logic, if you normalize for the Dish churn and exclude some one-time debt refinancing costs, AFO actually grew 4% on an FX neutral basis.
Yep. The core cash generation engine is humming along, right in that mid-single digit pocket. But again, it's completely masked by the Dish fallout.
Let's talk about adjusted EBITDA, because that grew 1% overall and 4% normalized. But the red flag for me, and I really want your take on this, looking through the supplemental materials, was the margin compression.
Yes.
Their cash-adjusted EBITDA margins dropped 110 basis points. They are fundamentally becoming slightly less profitable per dollar of revenue. Is that purely a function of losing high-margin Dish revenue that's dropping straight off the bottom line? Or is there a structural cost issue at play here?
It's actually a combination of factors, but the structural cost issue you're hinting at is very real. And it's primarily coming from their international portfolio, specifically Africa.
Africa, okay.
Yeah, the drop in margins isn't just lost revenue, it's an actual inflation of operating expenses. And the biggest culprit there is, believe it or not, diesel fuel.
Diesel fuel. That's a mechanic I think a lot of domestic retail investors just completely overlook, because operating a tower in the U.S. basically means plugging into the local municipal grid and paying a relatively stable utility bill.
Exactly. It's boring and predictable. But the infrastructure environment in emerging markets is totally different. Radically different.
How so?
Well, in many African markets, the electrical grid is highly unstable. In South Africa, for example, they deal with rolling blackouts, what they call load shedding, on a daily basis.
Wow. Daily.
Yes. And to guarantee the 99.9% network uptime that carriers like MTN or Vodacom demand, American Tower has to operate thousands of localized diesel generators at the base of their towers.
So they aren't just real estate managers, they're essentially operating micro-utilities.
That is a great way to look at it. They are basically power companies in these regions, and when global energy prices spike, or when local currencies devalue, making imported diesel astronomically expensive, the cost to keep those generators running eats directly into American Tower's EBITDA margins.
It's a massive, unhedged operational risk.
It really is. It's inherent to the international tower model. You get higher top-line growth in these emerging markets, absolutely, but you absorb a tremendous amount of operational volatility.
Which brings us perfectly to the regional organic growth breakdown, because this is where we see exactly how that global portfolio is actually performing.
Right, let's look at the regions.
Organic tenant billings growth in the US and Canada was 1%, or 5% excluding DSH. Europe grew a solid 4%. Africa and the Asia-Pacific region were absolutely booming at 11% organic growth.
Huge numbers there.
Huge. But then we have Latin America. It contracted. It posted negative 2% growth.
Yeah, the Latin American contraction is the other massive localized distortion we have to analyze here. Because you have double-digit growth in Africa, you have steady 5% core growth in the US, but Latin America is dragging the entire global average down.
And the primary catalyst for that is the telecommunications consolidation in Brazil, involving a carrier called Oi. Now, I know the Brazilian telecom market is notoriously complex, but what exactly happened with Oi, and why is it causing American Tower to lose 2% of its revenue across an entire continent?
It's a fascinating situation. Oi was one of the major legacy telecom providers in Brazil, and they went through a brutal multi-year judicial restructuring, bankruptcy, essentially.
Right.
Ultimately, the company was carved up and its mobile assets, its spectrum, and its subscriber base were sold off to the other three major carriers operating in Brazil.
Which are TIM, Telefónica's Vivo, and Claro. Right.
Exactly.
So we go from a 4-player market down to a 3-player market. But if Claro buys Oi's assets, don't they also assume Oi's tower leases? I mean, why does the revenue just disappear for American Tower?
This comes down to network topology. Imagine American Tower owns a highly desirable macro tower on a hill overlooking a really dense neighborhood in São Paulo.
Okay, I'm picturing it.
Prior to the bankruptcy, Oi was renting space on that tower to cover the neighborhood. But Claro was also renting space on the exact same tower to cover the exact same neighborhood. Right. So when Claro buys Oi's mobile assets, they inherit that Oi lease. But Claro's RF engineers immediately look at the network map and say, wait a minute, we are now paying rent twice on the same tower for overlapping, completely redundant coverage.
Wow, so consolidation inherently destroys tenancy.
It does.
The new combined carrier doesn't need 2 sets of antennas pointing in the exact same direction. They decommission the old Oi equipment, they break the lease, and they simply route all the traffic through their existing Claro antennas.
You nailed it. Mergers and acquisitions among carriers are the absolute bane of tower companies. You lose that beautiful high-margin overlapping rent. And management noted on the call that the churn they originally expected to happen gradually in 2025 and 2027 is all compounding and hitting the books simultaneously right now in 2026.
So they are taking the entire hit at once. Ouch.
Yes, it hurts. They view 2026 as the absolute the peak of the consolidation pain in Brazil. But there is a silver lining.
What's that?
The silver lining of market consolidation is that the surviving carriers become much healthier financially.
Right. Less competition means better margins for them.
Exactly. Once these redundant leases are fully scrubbed off American Tower's balance sheet, you are left with 3 highly capitalized carriers in Brazil who no longer have to engage in a race-to-the-bottom price war with a bankrupt competitor. And those 3 carriers have stated aggressive intents to deploy capital into massive 5G build-outs.
Okay, so just like the D-Dash situation, the Oi churn is an event-driven headwind. It's painful right now, but it resets the baseline. Management is predicting a return to positive organic growth in Latin America by 2027 because the underlying demand for mobile data in Brazil hasn't changed.
Exactly. The data consumption curve in Latin America is still exponential. People are still streaming video and using apps. Once the network topology is rationalized down to 3 players, those players still have to lease more tower space to meet consumer demand.
Let's pivot away from the pain points for a minute and talk about the absolute standout star of a quarter. Because ironically, for a company called American Tower, their fastest growing asset isn't a cell tower at all.
You're talking about CoreSite?
Yes, CoreSite. American Tower acquired CoreSite a few years ago to expand into the data center business. And based on these Q1 numbers, that acquisition is looking incredibly prescient.
It really is.
CoreSite posted a massive 17% cash revenue growth year over year. But reading through the transcripts, management is almost combative about the terminology.
Oh, they hate the term data center.
Yeah. They continually insist that CoreSite is not a data center. They want analysts to call it an interconnection hub. What is the mechanical difference there, and why does that distinction command a 17% growth rate?
The distinction is everything. When most people hear the phrase data center, they picture a hyperscale facility. You know, these massive, windowless, million-square-foot warehouses built in places like rural Iowa or central Oregon.
Out in the middle of nowhere.
Right. Outward land and electricity are incredibly cheap. They're usually single-tenant facilities built specifically for Amazon Web Services, Microsoft Azure, or Google Cloud, just to house tens of thousands of servers.
Right. It's essentially just industrial warehousing for computers. You're just providing bulk power, industrial cooling, and physical security.
Exactly. And it's a great real estate business, but the margins are capped because the hyperscaler, Amazon or Google, has all the leverage. CoreSite's model is entirely different. CoreSite operates highly dense facilities in major urban centers. We're talking downtown Los Angeles, Manhattan, Chicago.
Premium real estate.
Very premium.
Yeah.
And they aren't renting to one giant tenant. They are housing the critical networking equipment for hundreds of different enterprises, telecom networks, and cloud providers who physically meet inside the building to exchange data traffic.
You know, I was reading one of the analyst notes on this, and I love the analogy they used. If a hyperscale data center in Iowa is a massive long-term parking garage on the outskirts of the city, CoreSite is Grand Central Station right in the middle of Manhattan.
Oh, that's a perfect analogy.
Yeah, it's not where the data goes to park and sit idle. It's where the data transfers from one global network to another at lightning speed.
That is exactly it. And the true value of that Grand Central Station lies in what the industry calls cloud on-ramps.
Cloud on-ramps?
Yeah. If you are a major multinational bank or a healthcare provider dealing with highly sensitive patient records, you do not want your secure data traveling over the public open internet to reach Microsoft Azure. The latency is too high, and the security risks are completely unacceptable.
You want a private road.
You demand a private road. You want a direct physical fiber optic cross-connect. And CoreSite houses those physical on-ramps. The enterprise server sits in a cage right next to the AWS server, and they are connected by a literal physical fiber cable that never touches the public internet.
Wow. And this brings us to the AI catalyst, doesn't it? On the call, management explicitly called out AI inferencing as the massive new driver for CoreSite.
They did.
Now, look, we hear AI on every single earnings call right now. It's become the ultimate corporate buzzword. But when we look at the physical, mechanical layer of network infrastructure, what does AI inferencing actually require that CoreSite provides?
To understand that, you really have to separate AI into its two distinct phases: training and inferencing.
Okay.
Training these massive large language models like OpenAI's GPT-4 requires tens of thousands of GPUs running continuously for months. That requires gigawatts of power. Because it's an asynchronous process, latency, meaning the time it takes for data to travel over the fiber network, doesn't really matter.
The location doesn't matter because the AI isn't talking to a user yet. It's just reading the internet and learning.
Exactly. Therefore, training almost exclusively happens out in those remote hyperscale data centers where power is super cheap.
Okay, that makes sense. But inferencing is completely different.
Inferencing is when a user actually queries the model. When you ask the AI a question on your phone and expect a real-time voice response, or more critically, when an autonomous vehicle's internal computer needs to query a larger AI model to navigate a complex traffic situation.
Oh, wow. Yeah, a delay there would be disastrous.
Exactly. For inferencing, latency is literally a matter of life and death. The physical server running the AI model must be geographically close to the end user to eliminate the speed of light delay in the fiber optic cables.
Which is the core concept of edge computing.
Precisely. You have to push the compute power to the edge of the network right next to the consumer. And because CoreSite's facilities are located in dense urban cores and already house the direct telecom connections to millions of smartphones, they are the logical physical home for AI inferencing hubs.
Right. The pipes are already there.
Yep. If an AI company wants their model to reach a consumer in Los Angeles with sub-millisecond latency, they have to put their inferencing servers inside a CoreSite facility in LA.
And once they do that, the switching costs become astronomically high. Management noted that the vast majority of CoreSite's revenue comes from clients connected to 5 or more other networks within the building.
Which is incredible.
It is. Because if you are physically wired into your cloud provider, your telecom carrier, and 3 of your biggest enterprise clients inside that specific building, you are never going to break that lease. You're completely locked in.
It creates a network effect that is incredibly sticky. The more networks that connect in a CoreSite building, the more valuable that specific building becomes to the next potential customer. That's why they can command 17% growth and continuously raise rents without experiencing significant churn.
That's a fascinating business model.
Yeah.
But let's cross the Atlantic for a minute and look at their European expansion. Because there is a fascinating dynamic playing out there regarding capital allocation.
Oh, Europe is very interesting right now.
Yeah, Europe posted a solid 4% growth, but the major catalyst is a massive contract they've signed with Telefonica. American Tower is executing a 3,000-site build-to-suit contract across Europe over the next 10 years.
Yes. And understanding why Telefonica is doing this tells you everything you need to know about the barriers to entry in the tower business. Building a macro cell tower in the United States is complicated enough, but building one in Europe with its incredibly dense populations, centuries-old historic preservation rules, and wildly stringent environmental and municipal zoning regulations is notoriously difficult.
I can't even imagine. The NIMBYism not in my backyard has to be off the charts when you try to drop a 150-foot steel monopole in the middle of a historic German village.
It takes years of legal wrangling, environmental impact studies, and permitting. Telefonica looked at that regulatory maze and basically decided it wasn't a good use of their capital or their engineers' time.
Makes sense.
Carriers want to spend their billions on acquiring new radio spectrum and buying the latest Ericsson or Nokia 5G antennas. They do not want to spend their time fighting local zoning boards in Spain.
So they just outsource the headache to American Tower.
Exactly. American Tower has demonstrated an institutional core competency in navigating European permitting. And because it is so difficult, and because the carriers are so desperate to expand their 5G footprint, American Tower can demand premium yields on these contracts.
Right. Management stated they're achieving returns a couple hundred basis points above their weighted average cost of capital on these new European builds.
Which is phenomenal.
It really is. It is a highly profitable, wide moat deployment of capital. But this brings up a massive contradiction in their global strategy that I really want to dissect.
Okay, let's hear it.
We just established that Europe is growing at 4%, and it's a difficult regulatory environment. Earlier, we noted that Africa is absolutely booming with 11% organic growth, driven by explosive demographic trends and a voracious demand for basic mobile connectivity.
True.
Yet management stated on the earnings call that they are actively shifting 85% of their growth capital, their new investment dollars, back to developed markets like the US and Europe. Why on earth are you sending the lion's share of your money to a market growing at 4%? While starving a market growing at 11%. It seems insane.
I know, it seems totally counterintuitive if you were only looking at the top-line growth rate. But this is where portfolio theory and risk management dictate corporate strategy. It comes back to what we discussed earlier about the diesel fuel and the macro volatility.
Okay, elaborate on that.
Yes, the demographic demand in Africa and parts of Latin America is staggering. But the sovereign risk you take on to capture that growth is immense.
You're talking about currency devaluation.
Currency devaluation is the silent killer of international REITs. If American Tower builds a site in Nigeria, they are collecting their rent in Nigerian naira, but they're paying their corporate debt and paying their dividends to shareholders in US dollars.
Right, and the exchange rate isn't fixed.
Exactly. If the naira devalues by 30% against the dollar in a single year, which is not an uncommon occurrence in emerging market economies. By the way, that 11% organic operational growth is instantly wiped out when those earnings are translated back to the US balance sheet.
Oh, wow. So you can have a fundamentally incredible year operationally and still report a massive financial loss due to FX headwinds.
Yes. Not to mention the political instability or sudden regulatory changes in developing nations.
Okay, so it's a huge risk-adjusted calculation.
Management made a very deliberate strategic pivot a few years ago. They looked at the volatility profile of their earnings and realized that while emerging markets offer outsized operational growth, they make the stock incredibly unpredictable.
And investors hate unpredictability.
They despise it. American Tower wants to be viewed by the market as a blue-chip, highly predictable, sleep-well-at-night dividend compounder. To protect that dividend and to attract a certain class of institutional investor, they're consciously choosing to accept lower but incredibly durable risk-adjusted returns in the US and Europe.
So they are trading top-line velocity for bottom-line stability. They would rather have a boring, guaranteed 4% growth in euros or dollars rather than a roller coaster 11% growth in emerging market currencies that might just evaporate overnight.
Exactly. They aren't abandoning emerging markets entirely. They still allocate roughly 15% of their capital expenditures there to support existing clients, but they are actively right-sizing the overall portfolio. They want to ensure that a sudden macroeconomic shock or currency crisis in one developing country doesn't derail the entire corporate earnings target.
Which brings us perfectly to the 2026 projections, section 3 of our framework here, management guidance. Because management actually raised their full-year guidance across all key financial metrics.
It did.
And honestly, reading the release, it felt mathematically impossible. I mean, how do you raise your annual guidance when you have a 400 basis point drag from DSESH negative growth in Latin America, and you are actively pulling capital away from your fastest growing continent? It doesn't add up.
It is a bit of an accounting sleight of hand, to be honest. The underlying cash generation of the business didn't suddenly accelerate in Q1. The guidance raise is being heavily supported by two major macroeconomic and accounting tailwinds: favorable foreign exchange rates and straight-line accounting mechanics.
Let's break down the straight-line accounting first, because they explicitly noted that straight-line revenue is artificially boosting their numbers by about $35 million in Latin America right now. For an investor who doesn't spend their time reading generally accepted accounting principles, how is imaginary money showing up on the income statement?
It sounds nefarious, I know, but it's actually a strict requirement of GAAP accounting when dealing with commercial real estate leases. Let's walk through an example.
Please do.
Say a telecom carrier signs a 10-year master lease agreement for a tower. The rent in year one is exactly $100,000, but the contract includes a standard 3% annual escalation clause to account for inflation.
So every year, the actual cash the carrier pays goes up by 3%. By year 10, they are paying significantly more than $100,000 in cash.
Right. But GAAP rules dictate that the landlord American Tower cannot simply record the cash received as their revenue for that specific year.
Wait, really?
Really, the rules force them to calculate the total amount of cash that will be collected over the entire 10-year lifespan of the contract, divide that total number by 10, and report that average number, the straight line, as their revenue every single year.
Oh, wow. Okay, so in the early years of the lease, American Tower is forced to report a higher revenue number on their income statement than the actual cash that walks through the door.
Yep.
And then in the later years, they report lower revenue than the cash they are actually collecting.
Exactly. It smooths out the revenue curve for reporting purposes, but it completely divorces the income statement from the reality of the underlying cash flow.
That's wild.
And in the case of Latin America right now, because of the OI restructuring and various contract renegotiations, there were accelerated non-cash straight-line revenue recognitions.
Meaning?
The accounting rules essentially force them to pull forward a chunk of that future contracted revenue and recognize it today, even though the actual cash profile of the business hasn't materially improved.
That feels like a massive trap for a casual retail investor. If you just look at the headline saying revenue guidance raised, you might assume the core business just signed a bunch of new, highly profitable leases. You wouldn't realize it's just an accounting artifact.
This is exactly why specialized real estate analysts ignore GAAP net income entirely and focus obsessively on cash-adjusted metrics and AFO. AFO actively strips out that non-cash straight-line noise to show you the actual dollars hitting the bank account.
Okay, that makes sense.
Yeah.
What about the foreign exchange tailwind? Because they cited over $110 million in FX tailwinds, boosting the top-line outlook.
That is simply the math of currency translation working in their favor this quarter. The US dollar weakened slightly against the basket of international currencies where American Tower operates primarily the euro and the Brazilian real.
Okay.
So when the quarter ended and they had to translate all those foreign earnings back into US dollars for their consolidated financial reports, the same exact amount of foreign currency suddenly equaled more US dollars.
So again, a mathematical benefit completely independent of operational performance. They didn't lease more space, the exchange rate just shifted.
Correct.
But let's look at the absolute numbers they provided. They raised the property revenue outlook by $145 million, projecting 3% reported growth, or 5% normalized. They raised the adjusted EBITDA outlook by $205 million. And critically, they raised the attributable AFFO outlook by 12 cents to 10.99 cents per share.
That 10.99 per share figure is the absolute anchor for valuing the stock. It implies roughly 2% reported growth year over year, but again, returning to that 5% growth rate on an FX-neutral normalized basis.
And management was very intentional about framing the narrative beyond 2026. They firmly guided that once they clear these specific hurdles, once the DSH churn is fully scrubbed and the Brazilian OI consolidation washes through the system at the end of this year, they expect to return to mid to upper single-digit AFO per share growth over the long term.
That is the core promise they are making to the market. They are telling investors, look, 2026 is a messy cleanup year. Endure this. And 2027 is a return to the historical compounding growth trajectory you expect from us.
But if they are making that promise, we need to look at the foundation underneath it. The balance sheet. In a macroeconomic environment where interest rates are higher for longer, the cost of capital is absolutely punishing for capital-intensive real estate companies. If you have to refinance billions in debt at today's rates, it can completely wipe out your AFO growth.
Absolutely. The debt maturity schedule is the first thing you have to look at with any REIT right now, but this is where American Tower really distinguishes itself. They boast the lowest leverage and the highest credit rating in their entire peer group.
Let's define leverage in this specific context. They stated their net leverage ratio is 4.9x.
That means their total outstanding debt is 4.9 times their annualized adjusted EBITDA. In the commercial real estate and infrastructure space, a leverage ratio under 5x is generally considered pristine.
Okay, so it's very safe.
Very. Many real estate companies operate comfortably at 6x or 7x. Some highly leveraged plays sit at 8x. By keeping their debt levels so conservative, American Tower ensures that they aren't dedicating an enormous percentage of their cash flow just to servicing interest payments.
They have flexibility, and they are using that flexibility to reward shareholders aggressively. They just increased the Q1 dividend by 5%. Plus, they executed $184 million in share buybacks in the first quarter alone, bringing their total buybacks since Q4 of last year to $565 million.
Share buybacks from a REIT are a massive signal to the market. REITs typically issue new shares to raise capital to buy more properties. When a REIT stops issuing shares and instead uses its internal free cash flow to buy its own stock off the open market, management is making a definitive statement.
What's the statement?
They're saying, we look at all the potential acquisitions out there, we look at the cost of building new towers, and we believe our own stock is so mispriced and undervalued right now that the highest return on investment we can generate is simply betting on ourselves.
I want to challenge the optimism here for a moment, because the CFO did admit on the call that the higher interest rate environment is still going to be a drag. As their older, cheaper debt matures, they have to issue new bonds at today's higher rates, and they noted that refinancing will act as a roughly 100 basis point headwind to AFFO per share growth.
True.
Furthermore, they noted a slight slowdown in their services business, which is the revenue they generate from physically helping carriers install equipment. Are we sure they aren't playing defense here? Are they relying too heavily on accounting tailwinds and share repurchases to mask a genuine operational deceleration as the 5G build-out matures?
It is a very astute challenge, and it's exactly why the stock has been volatile. The 100 basis point debt refinancing headwind is a mathematical reality that they cannot avoid. But if you look closely at their capital expenditure behavior, specifically where they are allocating their development dollars, they are absolutely playing offense, not defense.
Where do we see that?
The clearest indicator of this is buried in the CoreSite metrics.
The power pipeline.
Exactly. During the call, management revealed that they have aggressively expanded their data center development pipeline. Historically, CoreSite was holding about 280 megawatts of utility power capacity in reserve for future development. In Q1, they increased that pipeline by 200 megawatts, bringing their total held capacity to nearly 480 megawatts.
Why is holding power capacity such a big deal? Why not just buy land and build the data center when the demand shows up?
Because in the age of AI, electricity is the ultimate bottleneck. An NVIDIA H100 GPU rack draws an obscene amount of power and requires massive liquid cooling systems that also draw power. You can raise $1 billion and buy all the chips you want, but if you don't have a dedicated industrial-scale municipal utility substation capable of delivering high-voltage power to your specific plot of land, those chips are useless.
It's just an empty building.
Right. Securing a power purchase agreement, or PPA, and grid interconnection rights from a local utility in a major urban center takes years of negotiation.
So American Tower is aggressively negotiating with utility companies, locking down grid allocations, and banking that physical power capacity years before they even pour the concrete for the new buildings.
Yes. That is hyper-disciplined, forward-looking capital allocation. They are physically preparing the infrastructure to absorb a massive impending surge in AI edge computing demand. You do not commit that kind of capital to securing utility rights if you are a management team trying to survive a slowdown.
Right.
That is the behavior of a company aggressively loading the cannons for a multi-year growth cycle. The power agreements are the leading indicator of future revenue.
That is fascinating. The municipal power grid is the actual moat. Well, okay, we have covered a massive amount of ground here. We've crunched the messy headline accounting. We've unpacked the localized headwinds with D-H in the US and OI in Latin America. We've explored the structural shifts in capital allocation away from Africa toward Europe. And we've analyzed the underlying mechanics of their AI data center expansion.
It's a lot to process.
It is. Now, it is time for the final verdict. What is the market missing, and how should an investor approach this data?
Our verdict on American Tower right now is decisively bullish, but it requires an investor to have a time horizon that extends beyond the next 2 quarters. The market is currently pricing American Tower based on the messy, JAP-distorted, event-driven headwinds of 2026.
The market sees the Dish-H cancellations and the OI consolidation and prices the stock as if the core asset is deteriorating.
Exactly. But as we've discussed, those drags are entirely discrete. They have a definitive expiration date. By 2027, the overlapping Brazilian leases will be gone, the Dish contracts will be written off, and the year-over-year comparisons will normalize. When you look past that 2026 noise, the macroeconomic tailwinds driving this company are structural and multi-generational.
The mobile data consumption is projected to double in the United States by the end of the decade and nearly triple in emerging markets. Just look at your own behavior. Think about the volume of high-definition video you stream over a cellular network today compared to 2020. That curve is relentless.
And that fundamental demand doesn't even fully factor in the physical engineering requirements of 6G. Management touched on this briefly, but the physics of RF propagation dictate the future of the tower business.
Walk me through the physics there. Why does 6G guarantee more tower revenue?
Because of the spectrum bands it requires. To achieve the massive data speeds promised by 6G, telecom carriers have to utilize much higher frequency spectrum moving into the upper millimeter wave and sub-terahertz bands.
And the higher the frequency, the shorter the distance the signal can travel.
Precisely. A low-frequency 4G signal can punch through trees, rain, and buildings and travel for miles. A high-frequency 6G signal carries exponentially more data, but it degrades rapidly. It gets blocked by foliage, weather, and even modern energy-efficient glass.
Wow.
Therefore, the only way a carrier can provide a seamless blanket of 6G coverage is by massively densifying their network. They cannot rely on one tower covering a 5-mile radius. They need significantly more antennas, mounted on significantly more structures, placed much closer together.
It is a forced multiplier for vertical real estate demand.
Yeah.
The carriers have no choice but to lease more space from American Tower to make the technology work. Combine that forced densification with the explosion of the AI edge computing market, driving 17% growth at CoreSite, and the fundamental value proposition is incredibly strong.
Absolutely.
So if you're looking at your portfolio right now, the question you have to ask yourself is, are you willing to endure a messy transition year in 2026 to buy into that 2027 growth?
If you already hold the stock, the mechanics of the business suggest you hold it tight. The balance sheet is pristine, the leverage is low, and you are being paid a healthy, growing 5% dividend to patiently wait for the accounting noise to clear.
Even if you are on the sidelines.
The current market myopia creates a distinct window of opportunity. The stock's headline growth metrics look artificially sluggish to casual screeners. You have a chance to acquire shares in a premier global infrastructure monopoly before the AI edge computing demand fully materializes on the bottom line and before the Latin American market rationalizes.
It's the ultimate picks and shovels play for the digital gold rush. You don't have to guess whether AT&T or Verizon will win the 6G subscriber war. You don't have to guess whether Microsoft or Google will build the dominant AI application. You just own the physical steel towers and the interconnected concrete buildings that all of them are absolutely forced to rent in order to survive.
Terrestrial wireless networks and dense urban interconnection hubs remain the most economical, scalable means of delivering digital capacity. American Tower is the premier landlord of that physical space. When you cut through the straight-line accounting fog, the engine is absolutely roaring.
It's a phenomenal business model. But before we wrap up this deep dive, there is one final provocative thought we need to explore. It's an issue that was brought up during the Q&A portion of the earnings call, and management completely dismissed it.
Oh, I know where you're going with this.
Yeah. But if you look at the trajectory of aerospace technology, it might be the single biggest existential threat to the terrestrial tower model.
You're talking about low Earth orbit satellites, the space race.
Yes. Just days before this earnings call, SpaceX hosted a massive diligence meeting regarding their Starlink direct-to-cell capabilities. And you have companies like AST Space Mobile actively launching massive unfurlable phased array antennas into low Earth orbit.
Right.
These satellites are essentially functioning as 10,000-pound cell towers in space, capable of beaming a 5G signal directly to an unmodified everyday smartphone in your pocket.
When the analyst pressed American Tower CEO Steve Vondran about this threat, he didn't even blink. He stated that he doesn't lose a second's sleep over satellites.
Interesting. Why?
His argument relies on the physics we just discussed, capacity and density. He argued that a satellite in orbit simply cannot provide the massive bandwidth density required for a packed urban environment like downtown Chicago or a crowded football stadium.
And he's right about that. The physics of spectrum reuse from 300 miles up simply can't match a dedicated fiber-connected tower located 500 feet away from the user.
Therefore, Vondran views satellites as purely complementary. He argues they are only useful for filling in dead zones in ultra-rural areas, places where American Tower hardly has any footprint anyway, because the economics of building a tower for 3 farmers never made sense.
But I think that is a dangerously static view of a highly dynamic technology. Think about the classic innovator's dilemma. Right now, yes, satellite bandwidth is limited to text messaging and basic voice calls in remote areas, but the capabilities of these satellite constellations are compounding rapidly. What happens in 5 years? What if AST Space Mobile or SpaceX begin disintermediating even a fraction of the rural and suburban towers?
It fundamentally changes the economics of the carrier. If AT&T realizes they no longer need to pay American Tower millions of dollars in rent to maintain terrestrial towers along rural highways or in sprawling suburban peripheries, they will cancel those leases and route that traffic to space.
Exactly. If the sky becomes a ubiquitous, low-latency network for the bottom 20% of data density, will the entire definition of a valuable tower asset permanently shrink? Does the viable tower footprint contract exclusively to dense urban AI nodes?
It's a profound question about the terminal value of the asset class. Is management being appropriately rational about the limits of orbital physics, or are they experiencing the classic hubris of the incumbent, dismissing a disruptive technology just before it achieves massive scale and eats their peripheral margins?
It's something to seriously mull over as you watch the skies in your portfolio. The ground beneath our feet is solid, but the network above us is changing fast. Thank you for joining us on this deep dive. We hope we helped you look beyond the headline noise, unpack the accounting mechanics, and focus on the fundamental realities driving this massive infrastructure asset. Until next time, keep digging into the numbers.
And remember, the clearest answers are rarely found on the surface.
Whether it's a medical x-ray or a Q1 earnings report, you always have to look at the shadows. Take care, everyone.